was initially greeted with a yawn in the stock market, instant criticism he should have done much more. Stocks briefly sold off. But those sellers made a big mistake, and the market made them look like idiots. Because once Powell started talking in the actual press conference, you realize, wait a second, this man's going full Malcolm X. He's going to stop inflation by any means necessary. Powell will raise rates until inflation's destroyed. Hard to avoid. It just doesn't matter. See, the die has been cast, so to speak. And many of the world's central banks are in slowdown mode to stop inflation. Incredibly, it's like no one expected it, even though it was obvious that inflation is a global problem, not just an American one. Now, I know that the Fed's just getting serious about inflation very late, I know. Right as we got our first set of Federal Reserve regional reports that were negative and housing starts missed big. They're way too late to the game. But where does that get you? I'm not a Monday morning quarterback. By the way, it's also like they're not 4 quarters and then it's over. This is a long game. Unfortunately for stocks, the two indicators that matter the most to the Fed might just be housing prices, which badly have jumped 20% year over year, and the Fed did nothing about it. That's got to stop. And unemployment, which I would bet has to raise to 5%, maybe even more, to break the cycle of wage inflation. Oh, and from the Fed's perspective, it doesn't hurt that declines in the stock market have already done more to undermine the wealth effect than anything else, especially because of your dwindling 401k. The pessimism is incredible, palpable even, including pessimism about stocks as measured by the bull-bear ratio, which is about as negative as I can ever recall. Amazing, when things get this negative, the proprietary S&P oscillator I follow is now at minus 10, the level has bounced off consistently for years. Then the crowd is usually wrong. But the pessimist crowd this time has been right so far.
Oh, screw it. Mexico. All I'm saying.
All right. Today is Thursday, June 16th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. Before we start, let's view some of the mail that we have, the comments from you guys. And it is regarding the fact that I've recently been criticizing the Biden administration's economic policy. And some of you are not pleased. You know, because we got the blue cult, the red cult, and if you criticize one but not the other, people get upset. Now, mind you, I'm of the philosophy of Michael Jordan, who said that Republicans buy sneakers too. In this case, Democrats buy sneakers too. So I'm not a fan of offending any team or the other, but we're talking about what here? We're talking about economics. We're talking about the economy. Who's leading the economy right now? It is the Biden administration. So who am I supposed to criticize? And you notice in all of these comments, you can pause and read them if you want, but they never mention, hey, you were wrong about this. The facts actually say this instead. It's not about that. It's about, oh, you're criticizing my team. What about the orange guy? How come you're not talking about the orange guy? Last time I checked, the orange guy is not the president anymore. He's not in charge of the economic policy. And by the way, you're sadly mistaken, because when the orange man was in charge, I criticized him all the time. Matter of fact, the messages I would get back then is people on the other side being upset that I'm talking about politics and economic policy. Why don't you stick to the stock market? What do you know about politics? The two are intertwined, don't you think? And now I'm getting it from the other side. This guy says, hey, why don't you stick to the stock market? Otherwise, if you keep talking about this, you're going to lose your viewership. It's going to get cut in half. Unsubscribe. You know how often I've been getting these threats of your viewership is going to go down, unsubscribe, yada, yada, yada. Back when I was criticizing the orange man, we got it from his fans. Now we're getting it from the blue cult. And when I talked about the thing and the jabs and all of that, people said, what do you know about science and health? Unsubscribe. You're going to lose your viewership. So I've been getting these threats all the time. And what do you know? The channel continues to grow. So what are you talking about?
What the hell are you talking about?
losing half of my viewership. If anything, the views are surging and the support is at all-time high. Have you noticed the participation in the tip jar program, for example? When your viewers are putting their money where their mouth is and supporting you, that in itself tells the story. So I'm not deterred or afraid about these threats that I'm going to lose viewership, yada, yada, yada. And by the way, thank you to everybody who's participating in the tip jar program, because here's the problem with YouTube. For example, yesterday, I've been up all night working my ass off producing a video. And then you have these bots and scammers who hit my videos constantly with false copyright claims, and reaction YouTube turns off monetizing the video. In this case, in yesterday's video, they turned off monetization for over 6 hours. And then they come out and say, oh, it was a mistake. We found out that this is a bot and it's a false claim. You're back in business again. In the meantime, I got robbed because my video was not monetized for 6 hours. So again, thank you for everybody who's supporting, because you cannot rely on these anymore. They don't care about the little guy. They don't care about independent creators at all. But here's the thing for all of these critics. You don't want to bet on Joey B right now. It is a sinking ship. He's not taking responsibility at all about what's going on in the economy right now. Matter of fact, he came out today and said the recession is not inevitable. He rejected the idea that the stimulus program caused inflation. So no responsibility at all. And the media, the oligarchs, they're already dumping Joey B. He's getting the pink slip sooner or later. The New York Times is now talking about insiders looking for a replacement in 2024, and nobody's happy with the Biden-Powell regime destroying the economy, destroying the stock market. Look at what's going on around you. You don't want to bet on a dead horse. And of course, we have other critics who say that I swear a lot in the program. And you know what? I've been reading this article today. It's about Charlie Munger, one of my heroes and idols in investing. And you know what? Charlie Munger happens to swear constantly. So there you go. If you don't like it, go yourself. But anyhow, let's talk about this stock market, because yesterday it appeared that we're in the clear. After Jerome Powell's conference, higher we go. And today we woke up in the morning with the Dow Industrial Average down by more than 700 points. It now lost the 30,000 mark. So why the reversal? What happened? We're going to talk about that and a lot more. But if you're feeling bad about the economy and inflation, you might want to track Shaq O'Neal and see where he's going to dine next, because apparently Shaq O'Neal buys dinner for an entire restaurant and leaves the biggest tip waiters have ever seen. So there you go. Let's have the Shaq tracker. But besides that, for the rest of us who could not track Shaq, we have to talk about the economy and the stock market. So let's do that. And here it is, in focus tonight. Today, the economy and the stock market got 3 major shocks. Shock number 1, the surprise from the Swiss bank. Shock number 2, Tesla price hikes. And shock number 3, the disturbing data we got from the housing market today. We start with the surprise rate from the Swiss bank, but before all of that happened, we got the news that Revlon, a major cosmetic company, filed for bankruptcy, and immediately trading overnight became jittery. But what sealed the deal is the news that we got from the Swiss National Bank of a surprise interest rate hike by 50 basis points. And this is the first time it happened since 2007. And immediately as a reaction, the Swiss franc shot up higher, the highest level since January of 2015. And of course, the US dollar, took a leg down, which in theory should have been supportive to the stock market. But the problem with this hike is it came out of the blue, defying all forecasts and expectations. Matter of fact, the SMB forecasted back in December of last year that at this time they will be cutting rates, not increasing rates. And just take a look at what happened right now. The June 2022 forecast is actually suggesting more rate hikes to come, all the way till 3%. What does that say? When you have the Swiss National Bank increasing interest rates out of the blue, followed by the Bank of England, and many more. This is a global tightening cycle, and it is an admission that inflation globally is getting out of control, and central banks have to be a lot more aggressive. So when the Federal Reserve, led by Jerome Powell, says that we're not going to see these 75 basis points increases more often, he's lying flat out. You're going to need 75 basis points increases and perhaps a lot more. Let's say 100 basis points. Repeatedly, if not even more than that. And the fear is the Federal Reserve might realize, finally, they are way behind the curve. And they're going to surprise us with a massive, giant rate hike. We're talking about not just 100 basis points. We're talking about 200 plus. Could it happen? The answer is yes, because inflation is in the driving seat right now. Not Jerome Powell, not the Fed. And for them to change seats and take hold of the steering wheel, they have to increase interest rates dramatically, shocking the system and getting ahead of the CPI. And the stock market succumbed to this reality today. And hence, the oversized reaction to the downside. But shock number 2 came from Tesla. Tesla announced price hikes. Now, why would that be a problem? The answer is it is suggestive that the demand in the economy remains hot, evident by the demand for Teslas. What does that mean? The Fed has to be even more aggressive. But the problem for the company is the following. The scarcity of supply combined with out-of-whack demand, the company has no other choice but to continue to increase these prices higher and higher and higher. The inflation problem is not done yet. There is no such thing as peak inflation. And this news confirmed that today, that we're going to continue to see price hikes, not just in Tesla, but across the economy. And the Fed has to be more aggressive. By more aggressive, we mean higher interest rates, much higher, to the point where interest rate hikes induce a recession in the economy, specifically higher unemployment. And now we even have Jim Cramer, as you've heard in the beginning of this video, suggesting that the unemployment rate has to go higher, above 5%, for this inflation to go down. Now, when it comes to the details of these price hikes for soufflés, in case you're planning to buy one, well, for the Model 3, no price hikes for now, except, of course, for the long-range model. I mean, who needs the long-range model anyways, right? It went higher from $54,490 to $57,990. This is the entry point, I believe. Then you have the Model Y. The long range went from $62,990 to $65,990, while the Model Y Performance went higher from $67,990 to $69,990. What about the Model S? Well, a few months ago, the prices on this soufflé went higher by $5,000, and now we're getting more price hikes. The all-wheel long range went from $99,990 to $104,990. Now, a question for Tesla culties: why would you buy the Model S right now when you have the Model 3, which is more dependable, reliable, and performs better, at least to my knowledge? I used to own the Model S when it came out initially in the beginning of the 2010s, but it was a newer model back then. It was glitchy, the range was absolutely horrible, but the cool factor back then was more noticeable. People would stop you and say, is this really electrical? How fast can it go? Can I see inside? Yada, yada, yada. But it was not a reliable car, so I had to get rid of it. But anyhow, let me know in the comments, why would somebody get the Model S right now? Then we have the Model X. The price on that one went higher from $114,990 to $120,990. Now that's a significant increase of about $6,000. So for all of these monsters, all of these out-of-touch politicians, like the Secretary of Energy, for example, who say, well, if you don't like gas prices, why not get an EV? Get yourself an EV. Let them eat Teslas. Well, your average American doesn't have $120,000 just laying out somewhere. And the hammer is coming down for Reverend Elon Musk and his scams, specifically Dogecoin, the pyramid scheme of Dogecoin. Elon Musk is now sued for $258 billion over a alleged Dogecoin pyramid scheme. Millions of people lost their money, folks. I remember last year, the Saturday Night Live, which was the top in Doge, by the way, but a lot of folks saw Elon Musk shouting to the moon and all of that stupidity, and they bought Doge right at the top. And look at this massacre. We'll see how this goes, but he is in trouble, and the hammer is coming down for Reverend Elon. And the third shock that we got today came from the housing market. Initially, we got home builders sentiment, which hit 2-year low in June. And then came the massive bomb, the nuclear bomb. U.S. housing starts dropped to 13 months low in May. Building permits down in the trash. So what is shocking about this? Here it is. The estimate was that housing starts will go down by 1.3%. The actual number that we got was down 14.4%. Unbelievable. The housing market is cooling down significantly, but prices are not going down, and hence the stagflationary force in the housing market. Now, prices are not going to go down until what? Until unemployment hit the economy. So when the Fed sells out the fantasy that they're going to tackle inflation by increasing interest rates dramatically, yet the unemployment rate will go higher to only 4.1% by 2024. Who are you kidding, Mr. Powell? To cool down the housing market effectively, you need higher unemployment. Much higher, so we can see foreclosures and folks getting out of mortgages, getting out of rents, and freeing out supply. That is the only way housing prices will go down. So when I say the Fed is hiding something big, they're hiding the fact that the economy needs higher unemployment rate for this inflation to go down. We're not just talking about 5%, folks. Unfortunately, we're talking about 8% plus. Now, how will the economy get there? The answer is higher interest rates. Much higher. Forget about the 75 basis points. Forget about the 3.6% by the end of the year that Jerome Powell saw this yesterday. It's going to go way above 5%. If that is the case, how high mortgage rate would go? Because right now, mortgage rates reached over 6% in this country. And the average payment, the average monthly payment for a regular mortgage, median home price, 20% down, 30 years fixed, the monthly payment shot up higher from about $1,200 to now $1,800 plus. So if the Fed is serious about tackling this inflation effectively, they're going to have to jack up these rates much higher, above 5%, and this will push the mortgage rate to double-digit territory. So the average payment will go much higher, above $2,500. Now we're talking about tightening. Now we're talking about folks not being able to chase the American dream of owning a house. I mean, the American dream is already dead. It has been reduced to a van, but it is about to get much worse. Here's a report from one of the hottest housing markets in the country, Arizona. Take a look.
We start tonight watching your wallet and the money move that will impact you.
Yeah, this is big. The Federal Reserve is raising rates. This is trying to fight off inflation. Rates are going up 0.75%. That's the most in nearly 3 decades. The idea of higher interest rates is to stabilize prices, slowing down spending by making it more expensive to be able to borrow money.
The average APR on credit cards is now at 20%. Car loans, they'll go up too, with monthly payments already at record high according to Bankrate.
And then there's the already climbing mortgage rates going up even more. ABC 15's Mark Thompson takes a closer look at what that means for Arizona.
Paul Murphy is breathing a big sigh of relief. He closed on his newly built home in Surprise just 2 weeks ago. He started with a quoted mortgage rate of 3%, but as time went on, the rates kept going up.
They were going from 3.0 to 3.2, 3.6. So we started getting a little spooked with things.
So he decided to get a locked-in rate of 4%, but that came with a huge penalty if he didn't close in 105 days, and his builder kept experiencing delays.
It was starting to get a little stressful.
Things came through just in time, and they were able to close, with mortgage rates now climbing to near 6%, he says.
We most likely, we would have probably been out.
Economists say the Fed's raising interest rates to 0.75% is in an effort to ease inflation, driving prices down on everyday goods and services, with an indirect impact on mortgage rates. According to the Mortgage Banking Association, the average contract rate on a 30-year fixed mortgage was 5.65% for the week ending June 10th, the highest level since 2008. But purchase applications on homes were down more than 15% from this time last year. Murphy thinks in the long run, this will finally lower home prices. One of his colleagues already saw this with builders in a new home development.
Some of the other developments that they were looking at with different builders, that they've actually lowered the price by about $75,000.
But in the short term, with higher rates, he says some will be priced out.
And unfortunately, it is probably going to cost some people the dream of getting their homes right now.
Yeah, buddy, the American dream is dead, so forget about it. Now, the Fed new dot plots say that the consensus for now is the Fed funds rate will get to 3.6% by the end of the year. That is a fantasy. We're going much higher, folks. We're going to 4% plus by the end of the year. It has to happen because the neutral rate right now is above 5%. I mean, let's play this game and assume that the CPI is right, that the inflation rate in the country is 8.5%. And let's be even more open-minded than that and say, let's stick to the core CPI of around 5.6%, because who cares about energy, food, and oxygen? Right? Nobody cares about that. That is out of the scope of the Fed. What a joke. But anyways, if we assume that the core PCE is at around 5.6%, you gotta increase the Fed funds rate above that rate to tackle inflation. For the Fed to be in the driver's seat, not in the passenger seat, letting inflation dictate what the next step is. The Fed has to be in charge by increasing the Fed funds rate above the core CPI, and in this case, it has to be above 5.5%. Put 2 and 2 together, if we get to 5.5% in the Fed funds rate, what will happen to credit card rates? What will happen to mortgage rates? What will happen to car loan rates? Now, the demand will get destroyed in the economy. It will be noticeable, and it's not going to happen without a recession. So this fantasy that we heard today from Joe Biden saying that the recession is not inevitable, what are you talking about here? For this inflation to go down, a recession is a must. That is the unfortunate reality. But before we get too doom and gloom, let's move on to cover the stock market for you and look for opportunities. We start with the performance of the major indices today, and here we go. The Dow Industrial Average was down by 741.46 points, or a decline of 2.42%. The Nasdaq down big, losing 453.06 points, or a decline of 4.08%. The S&P 500 also in the red, down by 123.22 points, or a decline of 3.25%. The sector performance awful across the board, red, no metals given today, and the decliners were led by energy, cyclicals, and technology. The advanced decline ratios, NYSE 7% advancing versus 90% declining. Stunning. And then we have the Nasdaq 14% advancing versus 80% declining. Look at the new 52-week lows in the Nasdaq. Unbelievable. 729 new 52-week lows today alone. Wow. Moving on to commodities. You want to talk about peak inflation or the 75 basis points scaring away commodities? Not going to happen. Matter of fact, the WTI crude went higher, scoring gains of about 1.5%. Brent lagging behind, scoring gains of a little under half a percentage point. The RBOB gasoline muted for the day, so are heating oil and natural gas futures. Now, of course, Joe Biden refuses to take any responsibility for what's going on in oil prices, the prices at the pump, due to his hostile policies against the oil and gas industry, combined with the reckless policy from the Federal Reserve and the reckless policy in Ukraine and the sanctions. All of that, you combine all of that together, we get these insane prices at the pump. We have a major problem with refineries. The hostile policies against the oil and gas industry disincentivized building more refineries, investing in new refining capacity in this country. We've been reliant on India and China for refined oil products. Well, guess what? China's down with the lockdowns and the insanity, so that is a no-go. And now we're left with reduced refining capacity. And that results in higher prices at the pump that you and I are paying right now. But Joe Biden is not taking any responsibility at all. He's blaming the refiners for being greedy and profiteering. What do you want them to do? This is not the Salvation Army. This is a company, for-profit company, under a capitalist system. Their number one duty is to produce profits to the shareholders. But this is not landing, folks. Just like the Putin price hikes, that did not land, and now the attack against oil and gas companies, that is not landing. So the next step by the Biden administration is to reduce exports, and hence reduce the demand on domestic oil supplies. That could work, but there is a catch. Joe Biden went all over Europe, encouraging them to cut their dependency on Russian oil and gas supplies, promising them that we are going to fill the void. Now he wants to reduce exports, and now the Europeans are left with their pants down. On top of that, the talk of the town in D.C. is the upcoming visit to Saudi Arabia, the begging tour. Joe Biden promised that he's going to make MBS a pariah. He played his cards, and he lost. Now MBS gets to play his cards, and he's going to win. He's going to humiliate Joe Biden for whatever deals he wants to score. And today, to send a message to the Biden administration that if your goal to come here is to talk us into being hostile to Russia, that's not going to happen. The Saudis visited Moscow today, cementing the relationship of OPEC Plus, and that leads us to your favorite update, sticking it to Putin, brah. Sticking it to Putin, brah. The headline reads, Putin just said that Russia will be raking in oil and gas profits for years to come, and 3 key data points show he might be right. Uh-oh. Another one, Germany paid Russia more than $12.5 billion for fossil fuels over the first 100 days of the Ukraine war. Analysis finds. And this is absolutely stunning. Remember how Joe Biden was touting seizing Russian assets, specifically yachts, from the kleptocracy? Well, here it is. Here's the catch. The craziest thing, quote-unquote, about seizing Russian super yachts is the U.S. has to pay for them, Biden National Security Advisor says on Hot Mic. Whoops. And here's the admission, folks. It's over. We've been saying in this channel that the sanctions are wrong. They're going to hurt us more than they benefit us. They're not going to do shit about stopping the war in Ukraine. Now we're vindicated again because Biden officials worry that Russia's sanctions were so powerful that they also brought economic suffering here in the U.S. It's done. They're waving the white flag, and they're quietly admitting that this stupidity was wrong from the get-go. Anyhow, back to the futures. What about softs? We're seeing a rebound in most futures. Lumber was up higher by almost 1%. Likewise, coffee was the leader of the gains, scoring 1.25% almost worth of gains today. And then we have cotton futures also closing the day with gains of almost 1%. Likewise, sugar also gained a little over 0.75% today. And then we have cocoa futures flattish, while OJ was the decliner of the day, losing about a little over 1.25%. What about metals? Massive rebound across the board, with exception of copper. Is Dr. Copper sending a signal here that the rally in metals that we got today is fake? We'll see. But there was a major mechanical reason behind the rally in metals today, and that is the massive decline in the US dollar, losing about 1.25% today. Why? Because the Swiss franc shot up higher, along with the British pound, the Japanese yen, the euro, on the heels of monetary tightening. As a result, gold was up, silver up, platinum up, palladium up, everything is up, scoring gains of almost 2% plus apiece. The only absence from the party came from copper. Who knows why? Is it a leading indicator that the rally was fake in metals today? Is it moving down due to a negative reaction from China? Who knows? But when it comes to meats, we have gains led by lean hogs, scoring gains for a little over 1.25% today. On the other hand, we have declines led by feeder cattle futures, losing a little over 1% today, while we have live cattle futures flattish. Grains, we have gains led by wheat, scoring gains of about 3% today, followed by soybean meal futures, closing the day with gains of almost 2.75%. Then we have corn, closing the day with gains of almost 1.75%. Soybeans, scoring gains of a little over 1%. Then we have flattish activities for oats, while we have declines led by soybean oil futures, losing about 1.5% today, followed by canola and rough rice, both closing in the red. Moving on to the big casino, the options market, what's going on here? The volume is higher for the three names, Apple, Tesla, Amazon, but for the rest of the market, the volume is down, and they're buying more puts than calls this time around. Not a good signal, but perhaps the contrarians will look at that as perhaps a sign that we're bottoming. We'll see. Apple came out at number one at around 1.5 million contracts traded today. About 50.5% of those were calls. At number two, Tesla, the souffle, at around 1.4 million contracts. About 48% of those were calls. And at number three, Amazon, at around 1.3 million contracts traded for the name today. About 49% of those were calls. Here are the unusual activities that took place in the options market today. We start with the ticker IWM for the Russell 2000. They bought the 144 puts, expecting more declines for the Russell, and this is for the expiration date, July 15th, with expectations the IWM could go down by more than 12% by then. They paid around $1.50 a piece to enter this trade, all in all spending around $5 million. What about the ticker LQD? This is the corporate bonds ETF. Now, this is a good indicator for the economy. We have more buying of the LQD. This is a sign that we're about to see acceleration in the pace of economic activities, more bullishness in the stock market. But when the LQD goes down, it is an ominous sign that the economy is slowing down, perhaps dipping into a recession, and it is a bearish sign for equities. Now, somebody's betting for more declines to come for the LQD. In this case, they bought the 103 puts for the expiration date, August 19th, with expectations that the name could go down by more than 5.5% by then. They paid around 90 cents a piece to enter this trade, all in all spending around $3.5 million. What about the trade for the ticker AMD for, you guessed it, AMD? They bought the $90 calls for the expiration date, July 1st, with expectations that AMD could move higher by more than 9.5% by then. They paid around $1.50 a piece to enter this trade, all in all spending around $1.5 million. And then we have the ticker COIN, Coinbase. Somebody's betting for more declines in cryptos, which will hurt Coinbase. In this case, they bought the 42 puts with expiration date June 24th, meaning next Friday, with expectations that Coinbase could lose more than 18% of its value by then. They paid around $1.60 a piece to enter this trade, all in all spending around $1.2 million. And lastly, at the bottom of the table, what about the ticker BX for Blackstone? We're seeing more and more bearish bets against Blackstone. Somebody's agreeing with me here that we're going to see a massive decline in real estate. In this case, they bought the $80 puts for the expiration date, August 19th, with expectations that Blackstone could go down by more than 11% by then. They paid around $5 a piece to enter this trade, all in all spending around $3 million. Moving on to the heat map analysis, what's going on here? A bloodbath across the board. Joey B and Jerome Powell are taking the selfie. We have flattish activities, and flat is good in a sea of blood, and mind you, we're still out of tampons, but the flattish activities came from the big pharma names J&J, AbbVie, Merck, and also from the big retailers, consumer brands, in this case Procter & Gamble and Walmart. But the outperformance came from gold. All of the gold miners surged higher, and that is due to the decline in the US dollar. Is that sustainable or not? We need to see a confirmation. If the dollar bounces back higher again, my hunch is the rally in gold miners will also reverse. So let's cover some corporate news here, starting with Uber. We have a leaked memo that shows Uber raising prices for riders in one major U.S. metro area to help drivers deal with high gas prices. Now, these companies will suffer tremendously if we have higher gas prices to come. We're talking about Uber, we're talking about Lyft. I mean, is Lyft already bankrupt or what? DoorDash, all of them are going to suffer. And then we have bad news from Ford, recalling over 2.9 million vehicles for the risk of rollway crashes. We already have at least 6 reports alleging property damage from this recall and 4 reports alleging injury in relation to this particular recall. Bad news for Ford. But we have bad news for the EVs, Lucid and Rivian, because Reverend Elon Musk is now warning that these rivals will go bankrupt. Entirely go buy unless they slash costs. That is rich considering the fact that Tesla is raising prices higher. They're not cutting costs, they can't cut costs, so they're jacking prices higher. But now he's saying Rivian and Lucid will have a problem if they don't slash their costs down. And I say, Reverend Elon, stick to your souffle because it appears that you got some trouble at home. And then we got the news from Amazon with the anti-union practices and the intimidation tactics. Amazon held 25 mandatory anti-union meetings each day in the weeks leading up to the Staten Island union vote. I mean, isn't this unfair advantage of influencing workers? In other words, intimidating workers not to join or form any unions? How is that legal? How is that free when your boss is putting a gun in your head saying, hey, you want to bargain for more? Here's more. This is the culture of oligarchy that we created in business in America. And then we got bad news for the WWE. This time around, Vince McMahon is in trouble. Apparently, the WWE board is investigating a secret $3 million hush payment to shut down a sexual harassment report against the boss, Vince McMahon. And I say Vince has no chance in hell. Time for retirement, buddy. And today we got news from Kroger, one of my largest holdings. Profits went higher significantly. Price gouging, no price gouging, who cares? Profits are higher, margins are surging, but the stock reacted negatively nonetheless. An important finding from this report is the following. The consumer is now buying more of the store brands, the cheaper brands. What does that suggest? The consumer is being squeezed. Inflation is killing the consumer to the point where they have to switch to store brands. What does that say about the consumer purchasing power in the economy? It's getting hit significantly, which will lead to more slowdown in the economy, perhaps more unemployment in the economy. This is the power of stagflation. So the message to Jerome Powell is the following. You still got the cushion for now. Unemployment, the purchasing power of consumer. You can do the rate hikes, the aggressive rate hikes right now. But if you wait, the consumer purchasing power will weaken dramatically and unemployment will rise significantly either way. By the time you do these sizable rate hikes, you're going to end up destroying this economy. Now, before we move on, here's a question from the viewer saying, hey Mav, what are your thoughts on CLF, Cleveland Cliffs, with a PE ratio of 2? That doesn't matter anymore. Everything is getting killed. And if we are heading into a recession, do you really want to hold on a cyclical stock like CLF or steel for that matter? Of course not. There is a time to buy these stocks, and the time is not now. Moving on to the heat map for the ETFs, a bloodbath across the board with exception of the inverse indices, the VIX proxies, and gold. Gold miners, the GDX, GLD, and commodities all managed to perform. But besides that, it is a bloodbath even in international markets. It doesn't matter whether it is value, growth, all down big. Moving on to charts, and we start with SPY, the S&P 500 30 minutes chart. What's going on here? The last support of 373.5 is lost for good now, and we're not going to identify any more support because this is a free fall at this point. But here's the catch. We have options expiration tomorrow. The expectations are for higher volatility, but keep this in mind. A lot of folks bought puts, a lot of folks sold puts, a lot of market makers sold puts. What does that mean? As we head into expiration with massive declines in the indices and other stocks, a lot of these puts are in the money, meaning the seller of these puts, the market maker, has to buy the underlying stocks. What happens when they buy these stocks to close the puts? We see a reversal and a move higher. So could we see a pop higher in the SPY and we see a recapture of 373.5 by the end of the day? That would be at least not a win, but at least it keeps the hope alive for the bulls that this is not going to be a free fall crash. Could it close the gap? That would be even better for the bulls, yet I'm not sure that will fix the problem here, because if we get a bounce based on mechanical reasons, in this case options expiration, that doesn't say anything about legitimate buying of the underlying stock, in this case the SPY. But without that, we could see a bull trap. A move higher, recapture of 373.5. The bulls say we're out of the woods. Higher we go next week, and what do you know? On Monday, the pies are ready to be served hot and delicious, right in the face. So we're not going to make any assumptions one way or the other based on a move from options expiration. But here's the daily chart for the continuous contract for the SPY. Believe it or not, the momentum indicators are down, but they're not oversold yet. Now, my support target is 3,600. Can we get there tomorrow? Perhaps. Preferably for the bulls, you want to get down there at 3,600, and then we get a massive rebound higher. And by the end of the day, SPY's futures, they managed to recapture 3,720.5. That would be the ideal scenario for the bulls, because you get a test to a lower support at 3,600, which everybody's anticipating right now, and then you get a pop not only closing above 3,600, but above 3,720.5. That would be a major win for the bulls. But all of these are just hypothetical scenarios. They could happen, they could not happen. We have options expiration. Anything would be in the table right now. Of course, for the bears, they're waiting for a retest of 3,600 and then a failure from that point on, which will accelerate more selling, more shorting, and then maybe at some point we see the RSI, the MACD indicators becoming really oversold. And then we get a technical, more reliable rebound than anything we're about to get from a mechanical reason of options expiration. Now, the volume went higher. That is a bad sign for the bulls, but a good sign for the bears that we could see more selling to come. Here's the Qs 30 minutes chart, similar story. We got a gap down, and the last support of 274.65 is lost for good now, but can we get a rebound based on options expiration tomorrow? Yes, we can. If the chart recaptures 274.65, that would be a win, but it is a weak, unreliable win. A more decisive win for the bulls that keeps the hope alive is closing the gap, and preferably closing the day above the gap. We're not asking for a recapture of 285. That is a long shot, but closing the gap is possible. It's kind of a long shot too, but still possible. Now, of course, if we get more downside tomorrow in the Qs, that shifts the focus to the daily chart instead, because we have support down at around 11,000. If that doesn't hold, then close your eyes and make sure that you have diapers nearby, because you're going to need them. Now, the bulls are hoping that that's not going to happen. If we go down and retest to 11,000, in my chart it is 11,058, doesn't matter which number it is a zone. We get down there and then we see a rebound and a close at the highs of the day. This is what the bulls are hoping for. Better yet, a reversal and a recapture of 11,689 as support. Could it happen? Yes, it could, under mechanical reasons related to options expiration. But for now, the volume went higher. On a down day, this is not a good sign for the bulls, but it is a good sign for the bears. The momentum indicators remain weak. They're not oversold yet, keyword yet. So for now, the bears have the upper hand. No doubt about it. The bulls will fight back if we see a reversal and a recapture of 11,689 by the end of the day. The IWM, the Russell 2000, 30 minutes chart, similar story here. The most important number is 164.91. That is the gap on the daily chart. A closing below this gap by the end of the week will be an ominous sign, not just for the Russell 2000, but for the entirety of the stock market. So the bulls better hope and pray that even if it is for mechanical reasons related to options expiration, the IWM pops higher and closes the day above 164.91. What about the Dixie, the dollar index? It is down for the day, but not breaking any major support, in this case 103. And what if this is a formation for cup and handle? What if we got today is a temporary decline in the US dollar due to the surge in the Swiss franc? And then we get a rebound and the dollar surges higher. If that is the case, then what we got in gold today is a bull trap. Yes, gold recaptured 1,840 as support, but if the dollar continues to move higher again, then the pop that we got in gold today will be reversed. Now, we have a question from the viewer with an analysis of the chart of gold. He's using a monthly chart, I believe, a longer range chart, and I looked it over. You're right, the formation is bullish, but under these conditions, you really don't want to do any longer term charts. You want to stick to the 30 minutes to the daily maximum. You want to take a look at the weeklies once in a while, but for now, looking at monthly charts or even the weeklies, things are unpredictable for now. Things are moving fast. You're going to find out that these monthly charts might not matter. And by the way, looking at this chart, what if we have a double top? That is another way to look at it. Moving on to the 4 hours chart of crude, in this case Brent, we got a breakdown, a bearish breakdown, losing support of the trend line and 118. But the reversal came by the end of the day, and the chart reclaimed 118 as support, and it is battling to reclaim the trend line as support once again. It is a battle. It is a bearish breakdown, no doubt about it, and therefore the bears, oil bears, have a point to argue with. That once you see these pierces and breakdowns of major support lines, it doesn't matter if you rebound higher. You're going down again. Yet oil bulls will read it another way by saying, hey, yes, it was a bearish breakdown, no doubt about it, but the reversal came fast, indicating that there is buying appetite in crude, in this case Brent. And not only we captured 118 as support once again, the chart is in the process of recapturing the trend line. If that is the case, higher we go to 124 once again. Now we'll see who's going to win by the end of the day, but for now, in my opinion, the bulls have the advantage. Here's the 10-year yield. It was a down day, it was an up day initially, and then it was a down day by the end of the day. The question is, are yields going down for the good reasons or the bad reasons? Are we seeing more downgrades of GDP growth estimates, for example? That would be yields going down for the bad reasons. But if we have more indicators pointing out for more growth in the economy, then the 10-year yield is going higher for the good reasons. But there is another reason, a mechanical reason, that pushes the 10-year higher, which is tightening, monetary tightening, which is not happening just in the US, but across the globe. So for now, we have to rely on the technicals. Is the RSI or the MACD indicator showing any sign that this run is over? Of course not. Because what if this is an A, B, C pattern? We got the A leg, now we're forming the B, maybe we're done with the B, and the chart is about to move higher in a C leg formation. And if that is the case, then the bounce that we got today in the TLT from a weekly chart perspective is not reliable, and it's not going to last. Now, the bulls would argue the bounce that we got today came on much higher volume, so the assumption is TLT should move higher. Now, your question might be, hey Maverick, the TLT moved higher, why didn't the NASDAQ move higher? You said that would happen. We have to back up and ask the question, was the rebound in the TLT based on the good reasons or the bad reasons? The good reasons would be that inflation expectations are moving down, and hence yields are moving down while bond prices are moving higher. The bad reasons would be if we have panic in the economy, if we have fear in the economy, and folks are buying bonds to seek safety and refuge. That is the bad reason. If that happens, you can see the TLT higher, but equities going down. And this is exactly what we got today. And by the way, now that I'm dumping stocks and raising cash like never before, I'm looking to park this cash in a risk-free spot. So I'm looking at treasury notes, for example, for 3 months, for 6 months. You capture 1.75% or 2.75% interest rate. That's not bad at all. Because for now, amidst the storm, the hurricane, if you want to use Jamie Dimon's analogy, do you park cash in equities? Of course not. Even the safest stocks could go down in this environment. Likewise, are you going to hold your cash in a savings account that pays nothing at all? I'd rather park cash in treasury notes and capture a yield, whatever that yield it is, for 3 months, for 6 months, until the storm is over. Here's the VIX. 4 hours chart. What's going on here? We have what it appears to be a double top for now. We have negative divergence in the RSI, and we have not a decisive negative divergence in the MACD, but it is showing red impressions in the histogram. Now, that could pop higher again, and that will come hand in hand with a pop in the VIX. Looking at this chart, it is indecisive. We have certain signs for the bulls to look forward to, for example, the double top and the negative divergence in the RSI. And we're talking about SPY bulls, of course. But the bears, the SPY bears, the VIX bulls, would argue, wait a minute here, the chart is still above 33, and we're not through with the positive momentum yet. At any moment, the RSI could firm up. At any moment, the MACD could firm up again, and we could see a shot up higher all the way to 40. It is a toss-up. Nobody has the advantage here, in my opinion, but they have good talking points. What about the VXN? Similar story here. NASDAQ bulls, VXN bears would argue that we have a double top formation, and the bullish momentum perhaps is peaking on the MACD. We will see a down day tomorrow in the VXN, which will come hand in hand with a pop in the Qs. On the other hand, NASDAQ bears, VXM bulls would argue, wait a minute here, nothing changed. We have positive momentum on both the RSI and the MACD indicator, and the chart is battling 40 as resistance. It is not through yet. We don't have any rejection candle. We don't have any sign of a reversal from this point on. So who's to say we're not going to see the VXN moving higher tomorrow? Again, both sides, both camps have an argument here. It is inconclusive. What about Apple, the daily chart, closing below the lows, previous lows, on higher than average volume? The momentum indicators are accelerating to the downside, all bad signs for Apple. The next destination could be 127.22 which happens to be the next support. Now, could the opposite happen and we see Apple trading higher tomorrow? Perhaps, but that would be based on options expiration activities, thus unreliable. Next, Tesla, the souffle, 30 minutes chart. What's going on here? It didn't go all the way down to 620.5, but it was a major reversal from the pop that we got in the aftermath of the FOMC that got us all the way to 700. That was a trap, and the gap down happened immediately. That is a bad sign for Tesla. When the chart makes it all the way to 700, closes the gap, almost climbs 700 as support, and then we see a massive, stunning reversal the following day, this is a sign for weakness, indicating lower lows to come. And lastly, BTC, tulips, what's going on here? It appears that the bear flag is forming and playing out. We have support, at least my support, at 19,550. We'll see what happens if we get down there. But is there any sign to buy BTC here? Of course not. Even if it rebounds higher, we have many other conditions that have to be met before we buy BTC again. So the assumption for now is down we go. But you have to keep an open mind because you got oversold readings in the RSI. I believe these are the most oversold readings we've ever had in the chart of BTC. That is a possibility for the bulls, but for now, the bears are in complete advantage here. And this dynamic is not going to change until we see Bitcoin recapturing 25,000 as support. That is a long way from this point on. And we're getting more details about the disaster in El Salvador. Apparently, the country lost $56 million in the crash in Bitcoin, but the president continues to buy the dip. Good luck. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? It says we have Jerome Powell delivering welcoming remarks, whatever that is. Maybe welcoming remarks at the Recession Club. We also have the Industrial Production Index along with capacity utilization and leading economic indicators. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend. Take care.